You have heard the term 1,000 times. Hedge fund, hedge fund manager, hedge fund billionaire. Hedge funds are betting against your city. Hedge funds bought up all the houses. And if you are being honest, you have a rough idea of what it means. Rich people put money together. Someone makes aggressive bets with it. Sometimes they win enormous amounts. Sometimes they blow up spectacularly. There is always a guy in a very expensive suit. But if someone actually asked you to explain it, most people would kind of wave their hand and say, it's like a fund that hedges things, which is technically correct in the most useless way possible. By the end of this video, you will know exactly what a hedge fund is, how it makes money, and why the whole thing is built in a way that benefits a very specific group of people. And spoiler alert, that group probably does not include you. Imagine a group of 10 very wealthy friends who all put money into a shared pot. They hire a professional to manage that pot and try to grow it using whatever financial strategies they want, with almost no restrictions. That is basically a hedge fund. The key word there is almost no restrictions. Regular investment funds, the kind available to normal people, are heavily regulated. They have rules about what they can invest in, how much risk they can take, and how much they have to disclose. Hedge funds mostly skip all of that. The trade-off is that they are not allowed to take money from regular people. In the US, to invest in a hedge fund, you need a net worth above $1 million, not counting your house, or an annual income above $200,000. The idea is that wealthy people are sophisticated enough to handle the risk. In practice, it just means the most aggressive financial tools on the planet are only available to people who already have a lot of money. Make of that what you will. The investors in a hedge fund are mostly institutions. Pension funds, university endowments, insurance companies, sovereign wealth funds, giant pools of money managed by professionals looking for above-average returns. They hand billions over to a hedge fund manager and say, go make us more. And the hedge fund industry is enormous. As of 2025, it manages around $6 trillion globally. That number has quadrupled since 2009. There are roughly 11,000 hedge funds worldwide, but the top 100 of them control about 60% of all the money. So yes, there are thousands of funds, but the real power is concentrated at a very small number at the very top. Here is where it gets interesting. The word hedge actually meant something when these funds were first invented. Back in 1949, a man named Alfred Winslow Jones came up with an idea. He noticed that no matter how good your stock picks were, if the whole market crashed, everything went down with it. So he came up with a way to protect against that. He would buy stocks he thought would go up, and at the same time, bet against stocks he thought would go down. If the market crashed, the bets against bad stocks would make money and offset the losses on the good ones. The two sides of the trade would protect each other. That protection is called hedging, like hedging your bets. That is literally where the name comes from. Now, the concept of betting against the stock is called short selling, and it is worth understanding because it shows up everywhere in the hedge fund world. Here's how it works. Say a stock is trading at $100. You think it is going to fall, so you borrow shares from someone who owns them, sell those shares immediately for $100 each, and promise to return them later. If the stock drops to $60, you buy the shares back for $60, return them to the lender, and pocket the $40 difference. That is your profit. But if the stock goes up instead of down, you still have to buy those shares back and return them. Now you are paying more than you sold them for. And because a stock can technically keep rising forever, your losses are unlimited. That is the terrifying part of short selling. Your upside is capped. Your downside is not. This is exactly what happened with GameStop in 2021. Several big hedge funds had massive short positions on GameStop, meaning they had borrowed and sold millions of shares, betting the price would keep falling. Then a huge wave of regular people on Reddit started buying the stock. The price shot up. The hedge funds were now losing money fast, and were forced to buy shares back at higher and higher prices to stop the bleeding. That buying pushed the price up even more, which made things worse. One fund, Melvin Capital, lost nearly half of its entire value and eventually shut down. Short sellers lost an estimated $6 billion on GameStop in total, which just goes to show that even the smartest people in finance get it spectacularly wrong sometimes. Beyond short selling, hedge funds use a whole range of strategies. Some look at the big picture. They bet on what currencies, interest rates, or entire economies are going to do. George Soros famously made $1 billion in a single day in 1992 by betting against the British pound. Some look for corporate events. A company gets acquired, they buy one stock and short another, and try to capture the price movement that happens around the deal. And then there are the quant funds, the fastest growing type, which use algorithms and computers to find patterns in market data and trade in microseconds. Renaissance Technologies, the most famous quant fund ever, has reportedly averaged returns of around 66% per year before fees since 1988. That number sounds completely fictional. It is not. This is the part that should make you raise an eyebrow. Hedge funds make money two ways: from the investments when things go well, and from fees. Always from fees, whether things go well or not. The classic fee structure is called 2 and 20. 2% of the total money managed every year, plus 20% of whatever profits the fund makes. Let's put real numbers on that. Say a hedge fund manages $10 billion. 2% of $10 billion is $200 million a year, just for existing and managing the money, before a single trade is placed, before a single dollar of return is generated. $200 million guaranteed. Then say the fund has a good year and makes a 15% return. That is $1.5 billion in profit. 20% of that goes to the manager as a performance fee. That is another $300 million. Total fees for the year, $500 million. The average fee has come down a little from the classic 2 and 20. The industry now runs closer to 1.4% management and 16.5% performance. But the math is still extraordinary at scale. The entire hedge fund industry collected around $120 billion in fees in a single year. And here's the detail that really matters. The management fee is paid no matter what. Good year, bad year, flat year, the manager gets paid. The investors absorb the losses and still hand over the management fee. The manager wins in almost every scenario. The investor only wins when the fund genuinely performs. There are some protections. High water marks mean the manager cannot charge performance fees again until they have recovered previous losses. That is fair. But the fundamental setup is that the person running the money has guaranteed income built into the deal regardless of results. And then there is a newer trick that most people have never heard of. Some of the biggest hedge funds now use what are called pass-through fees. Instead of charging a fixed management fee, they pass all of their operating costs directly to investors. Staff salaries, office rent, technology, data, travel, recruiting, all of it billed to the people whose money is being managed. One documented example, Balyasny Asset Management had a gross return of 15.2% in 2023. After all the pass-through costs and fees were taken out, investors actually received 2.8%. The fund made 15% and handed investors less than 3%. The rest stayed inside the machine. This is disclosed. It is legal. It is in the documents. And most investors would need a lawyer in 3 hours to fully understand what they agreed to. So who is this whole system actually working for? The managers do very well. Ken Griffin of Citadel reportedly made around $4.1 billion in a single year. These are some of the highest paid individuals on earth. The fee structure creates that. Guaranteed income from the management fee. Massive upside from the performance fee. It is a deal that is hard to lose for the person running the fund. For the institutional investors like pension funds, there is a real argument. They need returns that beat inflation over decades. Hedge funds give them access to strategies that can make money even when the regular stock market falls. That is genuinely valuable when you are managing money that needs to be there in 30 years. For you, the average person, you are a few layers removed from all of this. If your employer's pension fund puts money into a hedge fund and it performs well, you benefit a little without knowing it. If it underperforms after fees, you take that loss quietly too. No notification, no choice. No explanation. The hedge fund world is a clean example of how the financial system is structured. The most powerful tools, the most aggressive strategies, the biggest potential returns. They flow toward the people who already have the most capital. Everyone else gets the downstream effects without the direct access. That is not a conspiracy. It is just how the plumbing is built. What is a hedge fund? It is a private pool of money from wealthy people and institutions, run by a manager who can invest in almost anything using almost any strategy, and who charges significant fees whether the strategy works or not. It operates in a part of the financial system most people never directly touch, built on rules that most people never qualify for, generating returns that flow upward and fees that never stop.